Hi, this is Farzan Ghadially, your finance expert. Today we are going to really look at two aspects: the macro stability of the Indian economy and the funding winter that has been experienced around the world and India. A lot has been said of late in terms of the overall macroeconomic stability of the country. Over the last 2 months, we've experienced a lot of geopolitical uncertainty with the war between Russia and Ukraine, interest rates going up. So the world is really becoming a chaotic place to be in. Our neighbors, Sri Lanka, have gone through an economic crisis and they are in a devastation at present. It's extremely worrisome to really look at a country devastate this way in economic terms. So when we look at India, is India heading the Sri Lanka way is a question a lot of critics are really asking. So if you really look at India at present, the foreign exchange reserves that we have is a war chest of 590 billion US dollars. 590 billion US dollars is a substantial amount of foreign exchange that we really have. A lot of critics would say it was probably 600 billion plus some time back. But please keep in mind, the Reserve Bank of India buys and sells dollar to maintain the volatility and control the rupee to the dollar. Hence, this war chest that we have could increase or decrease depending on the overall currency volatility that is experienced around the world. If you really look at the external debt to GDP, in India is at 21%. A large part of that 21% is trade borrowings. When we look at trade borrowings, what does it imply? It implies it is rolled over every year. So in layman's terms, you don't have to pay that amount of money at the end of the year. You have a pay in and payout, hence there is a rollover. If you look at Sri Lanka, what really went wrong was their external debt to GDP was 65%, a humongous 65%. Hence, overall, if you really go about, the macroeconomic stability of India is intact. Among the emerging markets, we are one of the best emerging markets that's really there. A lot has been spoken about the rupee versus the dollar. As we should, probably the rupee is touching 80 or would have touched 80 and could slightly move here and there from the $80 mark. If you really look at it, from 1st of January 2022 till date, the rupee has depreciated 7%. A lot of people will say 7% is extremely high. But let's put it in the world context. If you look at other currencies around the world, the depreciation has been comparatively lower. If you look at the Turkish lira, 25% depreciation year to date. If you really look at the Japanese yen, 17% depreciation year to date. If you look at the pound sterling, the British pound, 12%. The euro, 11%. The Thai baht, 9%. Hence, comparatively, we are in a better place where we have just depreciated 7%. Overall, there is stability as far as the rupee is concerned because there has not been very high volatility or real crash of the rupee. The depreciation has been slow and steady. Hence, it is a bearable depreciation to keep the economics impact that's really there. What has the RBI done? The RBI has really looked at measures in the near term and medium and long term. RBI has allowed international trade to be settled in INR, in Indian rupees. Doesn't mean that overnight people around the world are going to start trading in INR. But in the short term, we would have a big benefit because we have a great relationship in terms of trade with Russia. The Russian-Indian trade is estimated about $13 billion. Hence, in the short term, the benefit will be to really purchase a lot of commodities from Russia to get down inflation. In the medium to long term, what the RBI has done is really it's trying to get the rupee more in demand. By doing so, they're trying to get the rupee in the SDR basket of the IMF. So, in a long-term basis, rupee will be a force to reckon with. Hence, in totality, if you really look at it, in terms of emerging markets, India is very safe. It has great macroeconomic environment at present. If you look at the balance sheets of corporates, they are deleveraged, they will probably get into the capex cycle as soon as a lot of geopolitical uncertainty will end in the couple of months. If we look at balance sheets of banks and lenders, that's a very important aspect because they are the balance sheets that will fund the real capex that is there. They are doing very well. Hence, overall, there is a lot of stability and there is a lot of reliance as far as the whole macroeconomic situation in India is concerned. So, we are nowhere close to a default. We are nowhere close to really going down, but we are going to grow higher and higher from here. Hence, if you really look at it, overall macroeconomic picture of the Indian economy, we are very stable. We are going to grow at a right pace. We are nowhere close to a default. We will continue to grow. What India will suffer from is basically like other emerging markets, what is really known as collateral damage. When you really look at collateral damage, the damage will be to a less extent to India, but there would be ramifications as far as the present economic conditions around the world are concerned. The biggest point that we should look at is inflation. RBI has looked at inflation data and estimate the latest data suggests that the inflation in India is about 7.5%. Unlike the US, where inflation is at 9%. 9% inflation for the US economy is extremely high. Hence, the Federal Reserve is going to increase rates. When the Federal Reserve increase rates by 100 basis points, that's by a percentage, almost 1.5%, it is going to have an effect on overall liquidity and overall capital flows around the world. Capital will flow back to the parent country and to safer assets. With interest rates increasing, what will really happen is the amount of liquidity and capital flow to emerging markets like India will get affected. Even at present, there is substantial amount of foreign direct investment and foreign portfolio investment that is flowing in the listed market. If you really look back at India in the last 12 months, substantial amount of capital has been invested in the unlisted space. When we are referring to the unlisted space, we are really looking at the startup ecosystem. The startup ecosystem in India has come a long way. In 2010, there were about 450 to 500 registered startups. Today, we have in excess of 70,000 startups that are really registered. Billions of dollars have been invested. There are hundreds of unicorns that are really there, and it is estimated that by 2025, India will have 250 unicorns. Unicorns are companies with a valuation of $1 billion. So, a large amount of money has been flowing into the unlisted space. If you look at the deal data that over the last 12 months, 2,600 deals have really happened in the early stage ecosystem. That is way higher than the 3 to 5 year average. The 3 to 5 year average is about 1,800 deals. If you really look at data from start of the year till date, we have looked at about 700 to 750 deals that have really already happened. Hence, we may end the year substantially short. We may end the year with probably 1,500, 1,600 deals. That is about 10, 15, 20% less than the 3 to 5 year average, but fairly low than the peak of last year. What is important is a lot of people have been talking that, the startup ecosystem will not survive. A lot of jobs have been cut in the startup ecosystem. But please remember, today startups provide jobs in numbers of 7 lakh to 7 lakh jobs a year. And what has been cut is 15, 20,000 jobs that have really been all over the media. So, if you really look at it in percentage terms, that's hardly 2 or 3%. When the economy tightens and things don't go good, across the world, any sector, you will always find jobs that are cut to an extent of anywhere between 2 to 5%. Hence, people shouldn't get carried away nor panic. The startup ecosystem is here to stay. There will be a lot of capital that will be invested. What will happen is, last year we saw a lot of crossover funds investing in India. Crossover funds are funds that invest in the listed space as well as the unlisted space. With the listed markets correcting to a large extent, amount of money that these crossover funds will invest in the unlisted space has substantially reduced. However, if the company is good, the VCs, the venture capital funds that are really registered with SEBI, the regulator, have raised substantial amount of money in the last 12 to 15 months. Hence, for the next 12 to 18 months, there is enough of capital available for good companies and they will get the investments. So what should really companies do? If you are a young person, you've started a company, what should you really look at? One, you should really look at cash flows, extremely important. It is very important to understand that you have to move from the game of valuation to creating value. You will have to create value for your investor, for your customer and overall ecosystem. Focus on cash flow, reduce your burn rate. That is the amount of money that you're burning or you're really spending as far as every month, every week, every year is concerned. Try and really conserve your cash so that you can survive for a longer period of time. Will this winter, as we call it, the funding winter, last forever? Definitely not. Historical evidence suggests, right from 2008 till now, these funding winters last for 6, 8 months, 9 months or maximum a year. So the endeavor of a good startup company or any good company should be survive the period. When the conditions are bad, survive and then thrive. Because after this long winter that we are experiencing in terms of funding, India will emerge as the best emerging market in the world and we will see a lot of sunshine, lot of capital being poured into India. The next decade definitely belongs to India and billions of dollars will really be invested. So just hang in there, be brave and survive this period that is really there. As far as investors in the stock market are really concerned, please do not have a short-term outlook. You will have to have an outlook in terms of 1 or 3 years. The stock market has done extremely well in the last 3 years. Hence, it has been corrected. We are in a bearish phase. The phase will pass. No doubt that the growth story of India is intact. Valuations have been challenged and valuations have corrected. So there will be a phase that we are going through right now where there would be corrections, but have faith and be invested is really the mantra. Stay invested for long term, be patient, have faith in the Indian economy because the Indian growth story has just started. So please remember, if you have a 3 to 5 year horizon, you will really make money in this market. For all our viewers, if you are a young company or a startup company that has ventured into business now, you've done the right thing, you've taken the right decision. More wealth will be created in India in the next 10 years compared to the last 75 years. This small phase, the bearish phase will pass. Have faith. Keep doing what is correct. Create value. Don't keep burning money. Create value for your investor, for your client. India is indeed the consumption capital of the world. For investors that are looking at investing in the stock market will go higher. It's a part of the cycle that's really there. And in order to beat inflation, probably stocks are the best asset class that one can look at. Hence, stay invested, have faith in the Indian economy, and do not worry. Even if the rupee touches 80 or 81, rapid depreciation of the rupee will not happen because the RBI will take care of it. And have faith in the government and the Reserve Bank, and we will emerge as the best economy in years to come. Thank you so much. Till we see you next time.
Subscribe to Midday India. Get direct notifications on all our videos by clicking on the bell icon.